Welcome back to the channel, and thanks for joining me. I'm Algabot, and today we're taking a close, educational look at an expert advisor for MetaTrader 5 called Volume Time Price Divergence. This is an order flow momentum strategy that reads market pressure in an unusual way by comparing two different averages of the very same price. Over the next few minutes, we'll break down the idea behind it, walk through its entry and exit logic in plain English, read the actual code together in MetaEditor, and then follow an illustrated chart showing both a long and a short example. Let's get started. So what exactly does this expert advisor do? At its heart, Volume Time Price Divergence is a lightweight order flow tool that doesn't require a full order book or level 2 data. Instead, it builds two separate averages of the same typical price and studies the gap between them. The typical price of each bar is simply the high, the low, and the close added together and divided by 3. Over a rolling window, 20 bars by default, the strategy calculates two averages of that typical price. The first is the time-weighted average, or TWAP, where every bar counts equally. The second is the volume-weighted average, or VWAP, where each bar is weighted by its tick volume. Here's the clever part. These two averages only differ because of where the volume was actually transacted. If the heaviest volume printed above the plain time average, the volume-weighted line is pulled higher, and that suggests buyers were willing to trade size at higher prices. If the heaviest volume printed below, the volume-weighted line is dragged lower, hinting at selling pressure. The strategy measures that gap, divides it by the average true range to keep it scale-free, and turns it into a single oscillator it calls D. A positive D leans bullish, a negative D leans bearish. Because the gap is normalized by volatility, the same threshold works across very different instruments. This makes it an order flow momentum, or trend-following, approach. It's designed for liquid instruments where tick volume is meaningful. Think major currency pairs like euro-dollar, gold, or a liquid index contract for difference. It runs on whatever single time frame the backtest selects. From an educational standpoint, it will most interest traders who are curious about volume behavior and order flow concepts, rather than those looking for a simple line cross system. As always, this is information for learning only and not financial advice. Let's walk through the mechanics step by step, exactly as the code executes them. The expert advisor works on completed bars, so it makes one decision per finished candle rather than reacting to every tick. On each new bar, it first gathers enough history, the lookback window plus the ATR period, with a small margin. Then it loops over the last 20 bars and computes 3 running totals: the sum of typical prices, the sum of volume-weighted typical prices, and the sum of volume. From these, it derives the time-weighted average and the volume-weighted average. It reads the average true range from the last completed bar, using a period of 14, and divides the gap between the two averages by that range. The result is the divergence value, D. Now for the signals. The strategy keeps the previous bar's divergence in memory so it can detect a fresh crossing rather than a stale condition. A long setup requires two things to line up. First, D must cross upward through the positive threshold, which defaults to 0.12 in ATR units. Second, the close must be above the time-weighted average, so that price itself agrees with the bullish reading. When both are true on the same bar, the strategy signals along. A short setup is the mirror image. D must cross downward through the negative threshold, and the close must be below the time-weighted average. Only then does the strategy signal a short. Because it insists on a fresh cross plus price confirmation, it aims to fire only when conviction is new and the two clues point the same way. Risk management is handled with the average true range as well. On a long, the stop loss is placed 2 ATR multiples below the entry, and the take profit 3 multiples above, a reward to risk of 3 to 2. On a short, those distances flip to the other side. The strategy holds just one position at a time. And while a trade is open, if D crosses back through 0, the strategy reads that as the order flow flipping, and it closes the position early rather than waiting for the stop or target. Otherwise, the stop and target manage the trade to its conclusion. That flip exit is a small but important detail. It lets the strategy step aside the moment the volume footprint disagrees with the open position. Let's read the core of this in MetaEditor. At the top are the input parameters you can adjust. Lookback, set to 20, is the window over which both averages are measured. ATR period at 14 is the average true range used to normalize the gap. Threshold at 0.12 is how far the divergence must travel in ATR units before an entry is armed. StopAtr and TargetAtr at 2 and 3 set the stop and target distances as ATR multiples. Lots is the trade size, and magic tags the strategy's own orders. Below the inputs is the heart of the logic. The divergence D is the volume-weighted average minus the time-weighted average, all divided by ATR. The strategy then checks for a fresh cross. Cross-up is true when the previous D was at or below the threshold and the current D is above it. Cross-down is the reverse, below the negative threshold. Look at the buy block. The long signal requires that upward cross and a close above the time average. When it fires, the entry is taken at the ask price. The stop is set below the entry by 2 ATR, the target above by 3, and the trade.buy call sends the order. The sell block mirrors it exactly. The short signal needs the downward cross and a close below the time average. The entry is taken at the bid. The stop sits above the entry by 2 ATR, the target below by 3, and trade.sell places the order. Each price is rounded to the symbol's digits by the normalized price helper before it reaches the broker. Both sides are symmetrical, same logic, opposite direction. Now let's bring it all together on this illustrated chart. Across the bottom you can see the divergence oscillator, D, with 3 reference lines. The 0 line in the middle, a bullish threshold at positive 0.12, and a bearish threshold at negative 0.12. On the price chart above, the blue line is the time average, and the strategy wants price to agree with the oscillator before it acts. Let's follow a long trade first, then a short. We open with a few candles drifting lower. Price slides down into a small base, and through those early bars the oscillator sits close to 0. The volume-weighted average and the time average are almost on top of each other, so there's no clear pressure either way. This is exactly the kind of quiet, balanced reading the strategy waits through. Then watch the base candle. Price stops falling, and the next candle turns up sharply, closing back above the time average line. At the same moment, the oscillator lifts and crosses up through the bullish threshold. That's the fresh cross the strategy needs. The heaviest volume has started printing above the plain time average, suggesting buyers are stepping in with size. Both conditions are satisfied together. The oscillator has crossed its upper threshold, and the close is above the time average. The strategy signals along, and you can see the buy entry marker on that turn-up candle. The stop loss is placed 2 ATR below, just under the base, and the take profit sits 3 ATR above, that 3-to-2 reward-to-risk framing we talked about earlier. From there, price follows through. The next candles push higher, each one closing near its high, and the oscillator climbs further into bullish territory, confirming the pressure is holding. Because the divergence never falls back through 0, the early flip exit stays quiet, and the trade is allowed to run. A few candles into the advance, price reaches the take-profit target, and the long is closed at the take-profit marker. That's the first sequence complete. A quiet base, a fresh upward divergence cross with price agreeing, and a run to target. Now the market rolls over, and we get the mirror image. After the peak, one candle stalls right near the highs while the oscillator quietly fades back toward 0. Momentum is leaking out of the move. Then a firm down candle closes back below the time average line, and the oscillator drops through the bearish threshold on the downside. This is the short trigger. The heaviest volume is now printing below the time average, hinting at distribution, and price confirms it by closing under the time average line. The strategy signals a short, shown by the sell entry marker on that down candle. This time the stop loss sits 2 ATR above the entry, just over the recent high, and the take profit is 3 ATR below. The decline then plays out candle by candle. Each following bar closes lower, the oscillator presses deeper into bearish territory, and once again the divergence doesn't flip back through 0, so the position is left to work. Price grinds down to the short's take-profit target, and the trade is closed at the second take-profit marker. Notice how, in both examples, the strategy waited for 2 independent clues to agree, a fresh threshold cross on the oscillator, and price closing on the correct side of the time average, before committing. That double confirmation is the whole idea. It aims to act only when a shift in participation is genuinely fresh and price is moving with it. And remember, this is a clean, illustrative example. Real markets are far messier, threshold crosses can fail, and losing trades are a normal part of any approach. This walkthrough is here to make the logic clear, not to suggest how often it works out. Everything here is educational information only. And that brings us to the end of our deep dive into the volume-time price divergence expert advisor. Today we covered the core idea, comparing a time-weighted and a volume-weighted average to read order flow pressure. Then we walked through the entry and exit rules, read the MQL5 code together, and followed both a long and a short example on the chart. I hope this gave you a clearer, more analytical picture of how the strategy thinks. Remember, everything in this video is educational information only, and not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses do happen. If you found this useful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment with any strategy you'd like me to analyze next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.